Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the news that moves those markets. And I don't know if there's much news this week, Rob. Gold holding in nicely. Well, let's not start with gold. Let's start with something else. The Dow holding nicely. You know, the Dow peaked out a couple weeks ago and taking a little bit of a pullback, nothing too exciting. Silver had a nice little bump up this week, still sitting in its big multi-year trading range. The Dow transport still floundering a little bit. Yeah, I don't think there's too much news in the markets this week, Rob. What do you think?
Well, if you call gold at an all-time high not news.
Oh, that's right. I'm getting tired of saying it over the last couple years. I keep saying all-time high. You know, minimal all-time high. I think we pushed a buck or two above the previous all-time high going back to December last year. But yeah, gold has had a heck of a run this week.
Well, and that's just it. I mean, we started 3 weeks ago, and I remember Tori mentioning gold steadily every day over the last 2 weeks, just steadily every day, a little bit higher, a little bit higher. And then this last week, boom, gold's up $100.
Yeah, you've got to have those big breakout moves. So if we go back a couple weeks ago, like you mentioned, we were looking at gold sort of down at the bottom end of its trading range and trying to figure out, okay, where are we going to put in our low? Are we going to push below the December lows or not? And we came just shy. You know, it didn't quite push below it.
Well, you called it too. You called it. You said, hey, I can like 1995 as a double bottom. And you were right.
Yeah, and it definitely ended up holding.
It did.
Now, what we could have also seen, like we've seen in, say, copper, or we've seen in silver, or we've seen in the US dollars, when we came back up to the top end of the trading range, which we first hit going back to about February 29th, just about a week ago, we could have turned back down from there and we could have kept compressing outwards. But lo and behold, we've had a pretty big 5 or 6 days here in the gold price, going from that top end at around 2050 all the way up to 21. We're about 2155, 2160 right now as we speak. So last time we were up here, it looked a lot different.
I think we're setting up, I mean, if we look at relative strength, just on the hourlies, like you mentioned earlier, gold showing very overbought. So if people are going to be coming into the gold market, call your advisor here at McIlvaney's. And my suggestion would be, let's just start dollar cost averaging at this time. What do you think?
Yeah, I think that's fairly reasonable, because when we get to prices like this and the way we did, if we look back to how gold approached these numbers back in December, you're talking about the bulk of trading happening on a Sunday evening in the U.S. with the Asian market open, and then finishing up on Monday for us, beginning of the week. And you're talking about gold in a single day basically going up $75 and down 150. I mean, it was a pretty significant swing day, up or down $75 either direction. So this time it's different. You're talking 5 or 6 straight up days, going from down in the low 20s, 20, 25, 20, 30. We sat there for about a week. And over the course of 5 or 6 days, pretty consistent growth. You're not looking at a spike. You're not looking at going up to take out standing sell orders at a higher price that people may have standing to lock in profit. You're talking about marching up towards that price, and now we've sat here for about 2 days. So unless we see a pretty quick turnaround in the price of gold, it's very possible we might get the breakout that we've all been promising for years, but just hasn't quite happened yet, and moving us into legitimate higher territory where the old highs actually become new lows.
That would be amazing. I still think that we're going to see a bit of a pullback from here. I mean, not huge, maybe back down in the 2060 range, and then kind of a 50% retracement from where we started to where we are now, and then start that march. Because seasonally, I mean, we look at it technically, but we also look at it seasonally. Seasonally, we're in the spring market. It's the strong market for gold. I think that we could back off a little bit here, maybe 50% of this move over the last 3 weeks, and then march forward again.
Yeah, if you look at some of the previous highs over the last few years, you're looking not exclusively, but probably 3 out of 5, 6 or 7 out of 10. You're looking at March, April, May being very strong months for gold. And then in the fall, traditionally, the rest of those highs are made up August, September, October, occasionally November, December. You don't tend to see a lot on the high end in June, July, August.
Right.
It doesn't tend to be a summer mover. So coming into March, right where we're at, it definitely lines up with the seasonal concept of how gold moves throughout the course of the year. And looking at the way this recent price moved, frankly, it's parabolic, which is okay. You've got to have one of two things happen if you're going to continue to move up, because you've got to shake the overbought out. This is about as overbought a market, I think, as I've ever seen, certainly in the gold price.
Yeah.
By terms of your moving average convergence and divergence charts, by terms of RSI, the relative strength index, you're looking at significantly overbought on the gold price. Now, you don't have to have a reversal to shake that out of the market. Like you suggested, we could have some playing around here, up or down $50, $75, to kind of calm the market down for a few weeks and allow it to build up momentum for another step.
I want to get back to something you said earlier because I didn't want to talk past that. When we did see that radical spike early hours, Sunday night, Monday morning out of the Asian market, that had all the earmarks of clearing the decks.
Yes.
And we talked about that back then.
Yeah, that's a concept we've talked a lot about through the years.
Yeah.
A lot of larger, very few bigger investors will sit at a computer with their finger hovering over the button. Unfortunately, that's how you want to picture it in your head. That's the movie set, the sweat, beating down your forehead, just waiting for that price. Realistically, you've got computer algorithms, or if you're an individual trader, you just go type in the price you're going to pay.
Right.
So there are definitely going to be pre-standing orders sitting at previous all-time highs. So going to what we saw back in 2020, back in 2022, we get it again in 2023. So of course you're going to have a lot of orders that'll get filled very quickly because they've been sitting there for months, maybe years in some cases. Profit orders. Well, that wasn't too long ago.
Nope.
There aren't a lot of people that didn't get their orders filled then that are sitting there going, oh, better get them in now. That's not how trading works.
No, and we saw those decks get cleared, and here we are getting back to what you just said a minute ago. This is a strong market.
Yep. That's why you saw us touch those prices again back on Tuesday. We're back into it again here on Wednesday. We haven't had that snap turnaround. And if it doesn't happen quickly, it probably ain't going to happen.
Right.
So lo and behold, just for fun, because Tori's not here, and I always like to be optimistic when he's not around because he wants it so much. Just for fun, let's extrapolate out some of these pricing and say, okay, well, if gold is finally going to take that second step forward, we took a first step forward. Went from 1,600 to 2,100. That's a pretty good first step. Or even if we just look the short term, we just go back to last fall, 1,800 to 2,100. Where are some of the price levels we could get to? And I think, don't quote me on this, but I think our next major ceiling is up there around 2,350.
Yeah, and we've been talking about that for a while now. Now, we may not get there this spring, or we could. Or we could stall and then go into the summer months and then pick back up again later in the summer, late summer, early fall.
Right. So I wouldn't be surprised, given the way gold has reacted over the last couple days coming back into this all-time high price. This isn't reversal action. This is continuation action. So barring any major players stepping in and pounding the gold price down, which happens in any market, barring something like that happen, we could see gold inch a little bit higher here, a couple $100 more. And I now wonder, is that going to get people's attention? Because the big panic here isn't normal trading. The big panic is when the general public steps in because their attention has been grabbed.
True. And there are a lot of people pounding the internet and the airwaves. By now, it's going to explode higher. I do expect to finish the year around 2,350. I expect to go into the summer months somewhere in the $2,150 to $2,200 price range, with a stronger move later in the summer, again, playing the seasonals, not the technicals. And then, of course, the fundamentals are the wild card that anything can change overnight.
And the only thing I think might be different from what you're saying is it might actually be quicker than you think it is. So
well, this has
we'll
certainly
have to
been
see.
quicker.
It happened a lot faster than we thought.
Yeah.
You know, I did mention a couple weeks ago, because of the speed at which gold took that move Sunday night, Monday, when that did happen, and the volume that it traveled over that short period of time. I did say once we got into the 2030, 2040 range, you know, once we broke through some of the more shorter term highs, there really wasn't going to be anything stopping between there and the all-time high. So it didn't surprise me that it did happen as quickly as it did. So the question is, what comes next? So we will see.
We will.
Silver, little bit different. Also had a pretty good week, but a little bit different. You know, silver is still being silver, still being stubborn silver, sitting there in the low to mid 20s, although we did break back above 24.
And that matters.
Which we haven't been above here since the end of last year. So it is good to see silver still rising. The silver floor has still been rising. It used to be 17 not too long ago. Then it was 21. Now it's 22 and change. So we do have a rising floor in silver and a pretty flat ceiling across the board around 26, a little over 26. So silver's moving back up towards its, I would argue, breakout levels. Those aren't the previous highs. Back when we got up close to 30, right at 30. But just like gold, you have these interim highs that are really holding the market in place. And then you have these outside of the trading range highs and lows. And those are, to me, a little bit less valuable, other than a next stair step we end up moving up towards. So if we see silver above 26, it's probably going to 30. Just like I said with gold, if we see gold above 2030, it's probably going to its all-time high. So silver, I'm hopeful. It's still got a little bit to go, a couple bucks here to play catch up. But if gold certainly holds where it's at or continues to rise, I wouldn't be surprised to see silver put on about $5 pretty quickly.
That would be amazing.
So we had a couple comments from our show last week, because we did dive pretty deeply into the ratio trading concept within the precious metals, using gold and silver as our primary example with ratio trading. And we had some great comments, and we actually wanted to acknowledge a couple and respond to a couple if we can. So Rob, I'm going to start with you. I'm going to hold the card up to my forehead. So here's a question for you. Ratio trading only makes sense with paper. Not a question, a comment. Ratio trading only makes sense with paper. The premiums on silver are too high to make ratio trading feasible. What do you think, Rob?
I think that's totally legitimate. And it's not just the premiums on silver. Even if we do bars, you know, silver bars to gold bars and back and forth, it's also the spreads, which is very concerning to me. Be that as it may, and I do agree with him saying that, we got to 115, 120 to 1 silver gold ratio a few years back during the COVID spike. And I was very reluctant to move accounts because of the premiums and the spreads, but even still, taking that into consideration, still could have come out physical to physical, bar to bar, at 95 to 1. And I think that would have made a lot of sense. And then, of course, silver is still floundering, but on paper, the numbers look amazing, but you can do it, but you have to take into consideration the premiums and the spreads. And then we have to look at the client's net holding and when he bought whatever metal we are trading out of, and how many of the other metals could he have bought. Let's say he's coming out of gold into silver. How many ounces of silver could he bought instead of gold? And how many ounces is he gaining total? So we do look at that. We're very sensitive to that. I do agree with the client. At the same time, it still can be done.
So I want to add something from that as you were talking. I've got a completely different answer to that. So
Of course you do.
which is along the same lines because you know me. Tori's always asking me, what's the numbers? What's the pullback levels? I'm like, let's talk about the concept. So let me talk about the concept here. Ratio trading in your paper account is not exclusive to the ratio trading in your physical metals account because your physical metals position is owned for a completely different reason and serves a completely different purpose than your paper asset position. And this is what we call the financial triangle. Ratio trading is not supposed to be the end all be all purpose of owning precious metals. It is the seasoning you put on top of the steak. It isn't the steak. It isn't the primary motivation. The primary motivation for owning physical precious metals is because the US government spends more money than they make on an annual basis, and they make up the difference through inflation and various forms of theft. So I will always own physical metals as a protection and hedge against that. And if I can sprinkle a little bit of ratio trading on top of my physical position, all the better. Now, when I look over at the other side of my triangle, not the foundation whose purpose is to be preservative in nature long term, but if I look over at the investment side of my triangle, everything is ratio trading. I don't care what you invest in, you are constantly ratio trading. You're looking at the value of owning one stock compared to the value of owning the other. You may do that in terms of US dollars, the way you look at it, but you're still debating if you're going to own Amazon or Facebook, if you've got a limited amount of money to own one or the other. You do the same in real estate. Should I own agricultural land? Should I own rental properties? What type of rental properties? What's the value proposition of owning a duplex versus a single family detached home? So we are always ratio trading. We just call it by different names, and we've got the US dollar in between the two transactions. All we're saying is you can do that within your physical metals position to some extent too. So it's not a replacement. The idea is just there are ways to bring the same concept of investment strategy, which belongs over on the investment side of your financial triangle. There are ways to bring that into the foundational side as well.
And I really like the way you put that, Miles. The bottom line here, though, for the client is how many ounces is he actually gaining from his starting point?
Yes.
If we can show anywhere from a 15 to 50% gain in ounces from his starting position, we're not going to go student body left and student body right. We're not going to go all in and all out, back and forth. But we are going to manage it in a strategy where we don't over allocate into any particular metal. Well, maybe over allocate to gold because I am a gold bug, but we're going to try to keep the white metals, the silver, platinum, palladium, to about no more than 50%. I mean, there are clients who are way beyond that, but that's their decision. I like to keep the white metals down in the 30 to 40 percentile range, no more than that.
Right. And I'm actually err that way as well, simply because, like I said a second ago, my primary motivation for owning gold is preservation first.
Correct. Yeah.
So you can spend a lifetime buying gold, never ratio trade once, and do
fine.
great. So it's not the motivation. It sounds good. It's a great sales pitch. And frankly, it's pretty successful when it happens, but don't make it the priority within your metals investing. It's a phenomenal thing as an add-on. So speaking of ratio trading, let's follow up with the second point here, because I think this is also worth mentioning. Is there a principled reason why gold-silver trading is a preferred strategy over, say, gold versus oil, gold versus the Dow, gold versus platinum, etc.? And this is where I'm going to shut my mouth, Rob, because you've actually got the history here on a couple of those.
Yeah, going back 25 years ago, we started really dealing with the concept of the gold to Dow ratio, or the Dow gold ratio, going back 100 years when Charles Dow invented the idea of an index of 20 different industrial companies, and creating the Dow Index, which later became known as the Dow Jones Index, and versus the gold price. So when we see, yes, that index trade back to where it only takes 5 ounces of gold or 4 ounces of gold to equal the Dow Jones Industrial Average, you bet we are going to recommend reshifting that perspective triangle to where suddenly your foundation, your preservation asset is worth far more than your growth and income side of that triangle. And you are going to want to start deallocating some of those ounces of gold back into growth and income. That's why David McAlvany established McAlvany Wealth Management for that very purpose, is to give people an exit strategy for some of their gold to rebalance their triangle for their preservation, growth and income, and liquid assets. As far as gold to oil, you can certainly try that. It's not something that we do, but gold to platinum, yeah, I've done that. And platinum has been hugely disappointing. But taking an ounce of platinum and buying 2 ounces of gold with it, absolutely, we've done that. But now it only takes 2 ounces of platinum to equal an ounce of gold. Is it time to look at that ratio again? We can, and we'd have to dig deep into the outlook and the future for platinum. Most of the world's platinum, at least 60 to 70%, comes from South Africa. And that country isn't very strong right now, so there could be a disruption in supply if South Africa can't keep up with orders. Platinum is being reused again in automobile gasoline engines for their catalytic converters. So there is a play there, but I would be very careful. Maybe a 5 to 10% allocation of your overall precious metals portfolio from gold to platinum at this time. But you want to be very cautious because platinum has been hugely disappointing, as has silver.
Yeah, and our final concept, been waiting for years for that ratio to drop. It is definitely a long-term play, even generational, as you say.
Yeah.
Yeah, and I think one other thing might have to do with how we present information as well. I think one of the reasons we fall back on the gold-silver ratio, especially so much on this show, is because you do see smaller transitions back and forth more frequently than you do with, say, Dow Gold or with, say, platinum gold. Dow Gold, what is it? 1-to-1, 2-to-1, 3-to-1 over the last 100 years.
Yep.
The big trades, Dow Gold, there's been 3 of them in 2 of my lifetimes. So we talk about gold, silver because we're trying to teach concepts, but realistically, you can take any 2 assets on the planet, and with a little bit of research and a whole lot of data, you can figure out those ratio trades too. So this is more about teaching the concept, and it's easy for us in gold and silver just because we've got decades worth of data to fall back on. So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, you can hit the subscribe button, ring the bell, or better yet, head on over to our website. We can be found at McAlvany.com. If you'd like to speak with Rob, myself, or any of the advisors here at McAlvany Precious Metals, you can give us a call. We're at 800-525-9556. You can also find us on Twitter at ICA Gold or Facebook at McAlvany Financial. Thanks for listening and have a great week.